We are going to stay on the theme because in Washington, the House could vote this week on a bill that would allow the U.S. to put tariffs on Chinese goods if China doesn't let its currency get stronger. Fred Neumann is with us now. He's a senior Asia economist at HSBC in Hong Kong. Fred, thanks so much for joining us this morning. We heard yesterday there was some news breaking about China wanting to put a tariff on U.S. imported chicken to China. Is this a preemptive strike against what the House may do this week in the U.S.?
I think, yes, it's a bit of a tit for tat, if you will. We have posturing on both sides. We have clearly very significant developments in the U.S. with protectionist measures being voted on in Congress. And therefore, the Chinese also want to demonstrate that China itself is a large market, important for U.S. companies, and I think it needs to be seen in that particular context.
So who has more leverage right now, Fred?
It's very difficult to say. Clearly, the Chinese have a keen interest in exporting to the U.S., but at the same time, the Chinese are also financing the U.S. budget deficit. So the U.S. has actually an interest in keeping the Chinese sort of interested and engaged in the U.S. as well. So I think we're really all in the same boat here, and for that reason alone, I would expect the tensions not to escalate too far, and that calmer heads then will prevail ultimately.
So in other words, the stakes are too high for both countries to go much beyond arguing about a tariff on chickens.
The stakes are too high, and I think if we just take a step back here, it is one of the most important economic relationships in the world. If really we were to have an escalation of tensions here, it would reverberate across the globe. And I think for that, the institutional framework of the global trade agreements are too strong, and there's a lot of interest in keeping capital and markets open, and therefore our perception is that freer markets will prevail and calmer heads will prevail. So,
Fred, one thing to note, we had the Chinese Premier Wen Jiabao here last week in New York City speaking at the UN, and he said, look, the U.S. always wants to make China the bad guy, or at least this was the implication. But if the U.S. were not buying goods from China, they would be looking to import them from a cheap labor source from someplace else. I'm assuming that's sort of the general view seen from the Asian point of view.
Yes, I mean, there are a lot of other countries that could supply goods cheaply to the U.S. Mexico, for some time, was a key provider of cheaper goods to the United States. But I think the issue that Americans would have with that particular argument is that other countries have always allowed the exchange rate to adjust generally over time, and the Chinese are managing their exchange rate more tightly. And therefore, it's not just an issue about where you source cheap labor from or cheap goods from, but it's also an issue of whether one interferes in exchange rate management. And I think this is a particularly new issue, also given China's size. And we all have to concede some ground here, and I think ultimately a gradual appreciation of the Chinese currency would be in everybody's interest.
Thanks, Fred. Fred Neumann, HSBC.